I'm Joanna Simpson here at Risk Minds International in London. Joining me now is Dominique Bourrat, board member and ESG Strategic Senior Advisor at BDI. Thank you very much for doing that.
Thank you for welcoming me.
And just start by telling me, what are the risks associated with investing in ESG in emerging countries?
Yes, right. The investments in ESG are being referred as impact investments because those investments are supposed to bring value in terms of the environment or the society. And the investors usually perceive these investments as being risky because emerging countries most of the time do not have a very well-established local capital market. There could be political risk associated to those emerging countries, and also impact investments in general do not lead to the same profitability as normal investments, because people have still the perception that if they invest to create impacts, they would have to sacrifice profitability for those investments. That might not always be true. That depends upon the time horizon. That depends upon the way the investments are being risk diversified. But in order to address this risk, there are several solutions that we will come back to them later on. Another risk is the illiquidity of the assets. For instance, they want to invest into a land to restore it. It's not that liquid if they want to sell the land. So these nature-based assets sometimes can be very illiquid. That's another type of risk for them. And the cost of those transactions can be very high, because if we take the example of agriculture, which is a very important sector for ESG, for the nature-based assets, you have to invest into a lot of very small farmers, meaning that the ticket size of the transactions would be very low. Those farmers, they might need, for instance, grants of 10,000 euros. And for investors, that doesn't make any sense to do a full due diligence to just grant 10,000 euros a month. You know, they are looking for much bigger ticket sizes in order to decrease the overall cost of the transactions. So this is a key entry barrier as well. And the other thing as well is that some investors on the contrary told me, I am more than willing to invest into this, but there is a lack of bankable and very well structured projects. So there is indeed a gap between the projects that actually exist in emerging countries, but the investors are not fully aware of those, or when they are presented to investors, they lack a very strong business case because those people are not used to also talk a business language and interface with very large investors. So those are really the key risk and the key bottlenecks for investing in ESG in emerging countries.
So it sounds a bit like a catch-22 situation where the emerging markets need investment, but the financial institutions perceive it as being perhaps too risky. So how can we address this?
Yes, so that's true that it can be a little bit difficult, and here we face this gap. So one of the solution could be, you know, that greenwashing is something that is very important for the investors today. So if we could reassure them, for instance, that if they would invest into this impact investment in emerging countries, they could make sure that they create impacts, for instance, then they can claim to the regulators that they have impact investments that are not greenwashing. That could be a plus for them. And the way to reach that is to work with scientific partners, for instance, who have the tools and the means to really monitor the impacts locally in emerging countries and reassure the investors that it is not greenwashing and that their funds could be labeled Article 9, which is the highest label that they can get in terms of ESG. So that could be a driver, and this scientific company, these neutral companies exist today that could play a very important role for impact monitoring purpose and technical assistance for investors. So that's a way of doing it. Another way to reduce the transaction cost would be to be able to pool this small ticket size in order to come up with much bigger size transactions. So pooling could be also a nice way of addressing these issues. And in terms of liquidity, that's inherent to some natural assets. But I think personally that the fact that we have not seen some of the impact investments being profitable, it's because it doesn't attract always the best-in-class asset managers, because we have not seen yet best-in-class asset managers being really into that impact investments in emerging countries. I think that with more talented asset managers, we could most probably also capture good alpha performance even with impact investments.
So this time next year, which ESG topic do you think we'll be discussing?
I think that for me it would be biodiversity and nature risk. So we are facing a next wave after climate finance, which is really nature finance. And climate and nature cannot be dissociated. So far climate has been taken on its own, and now we realize how important it is to tackle both climate and nature at the same time. So I would like to see it being discussed at the next conference with nature and climate integrated scenarios and global methodologies to address both issues at the same time.
So lots of changes on the horizon.
Yes, a lot. Yeah.
Thank you very much for your time today.
Thank you.
Thank you.